To understand how to build a billion-dollar company, I interviewed two-time unicorn CFO Adam Swiecicki and partner at Initialized Capital Zoe Perret. With Adam having raised over $2 billion while leading multi-billion-dollar startups, and Zoe having invested in multiple unicorns at the seed stage, their advice spans the spectrum, from early-stage investor to late-stage growth CFO. This video contains their guidance on how to prepare for a fundraise, a founder's most critical skill, how to choose the right investor at each stage, setting your target raise amount and valuation, and executing after you raise, including the competitive advantages and 2 golden metrics that create billion-dollar startups. Welcome to Spendsetters, where you get expert advice from trailblazers in finance, all presented by Rippling Spend. To set the scene, Adam highlights 2 major themes for fundraising today. First, value is concentrating in fewer and fewer companies.
You are seeing this flight to quality within late-stage companies. There's probably 5 to 10 late-stage companies that if you asked a typical VC about, they would kind of talk about the same 5 to 10 companies that they would want to put money in.
In other words, the requirement to be exceptional in order to raise money has never been higher, and I'll explain what this means in just a second. The second change is that companies are staying private for longer.
You used to go public at roughly $100 million of ARR. That used to be the rule within software. Now you're seeing companies stay private for longer and longer.
This shift means that your fundraising strategy and investor relationships become increasingly important because they'll be with you for much longer and therefore will need to support you for much longer. So let's dive into what being exceptional means and how to pick the right investors. Adam emphasizes that much of your fundraising success is determined before you even enter the room with investors.
Every battle's won before it's fought. It really depends on everything you've done up until that point. It's not about raising well. It's about your financial plan.
And this is true at both early and late stages.
It is still extremely difficult to raise even at the A, and you have to be exceptional.
So, based on what Zoe and Adam had to say, here's what exceptional preparation looks like. Cultivating relationships with target investors well in advance, building and executing against a solid financial plan, creating a comprehensive data room 1 to 2 months before the raise, developing materials that showcase your metrics and growth story, and finally identifying potential weak spots investors will highlight and preparing for them. Now, when it comes to your financial story and your metrics, you might be wondering, is there some sort of scorecard or checklist where if I hit XYZ numbers, I'll be able to raise money? Zoe actually cautions against this kind of thinking, saying this.
Founders come with hey, what's a scorecard for raising an A? Hey, what's a scorecard for raising a B? And we've tried this exercise internally, and we tried to make, scorecards for consumer, scorecards for consumer hardware, scorecards for consumer healthcare. And at the end of the day, if you're not the outlier, you are not going to raise. Giving a scorecard to all of the founders is essentially advising to the average, and oftentimes the average is not who is raising.
While Zoe advises against over-indexing on scorecard-like metrics, she did offer that 3 to 5x revenue growth year over year and very low churn numbers is a good place to start for Series A companies. When it comes to raising in early stages, being able to drive exceptional growth is table stakes. Beyond this, the key factor to being exceptional and raising at the A is being adaptable. Zoe sees adaptability as the decisive factor separating startups that fail and those that succeed. Because when reflecting on her conversations with startup founders who had to shut down their business, Zoe had this to say.
Every single founder had said something to the effect of, I wish I realized when I was in that moment and it wasn't working that I should have just immediately jumped into something else. That lack of adaptability is what we're seeing as really the killer right now amongst the really, really increasing competition landscape. Is this founder going to have the adaptability they need to be able to pivot whenever all of these new changes are coming out every single day?
For early stage companies, adaptability isn't just about strategy, it's about runway. Now, as we discussed, selecting the right investor is more important than ever, and the approach differs dramatically by stage. For early stage companies, Zoe emphasizes choosing a partner, not just the biggest check, because this is often going to be a 10+ year relationship, and having someone on your board who makes it more difficult to make decisions, especially when things are not going well, is not worth any amount of money or whatever resume and background they may have. Early stage founders should look for board members who match your communication style, can help you navigate tough times constructively, bring relevant operational experience, and have worked with similar companies in the past. For later stage companies, Adam recommends focusing on the investor's structure and mandate. Again, with companies staying private for longer, Adam gives this advice.
You want to construct a set of investors who have the mandate and the ability to hold your stock for a very prolonged period of time as a private company, and also inject new capital into that business as you continue to grow. You don't want investors who or invested in the company where they themselves need liquidity at some point while you're still private and you're sort of trying to fundraise while those companies are themselves trying to sell stock.
The types of investors who might fit the bill include sovereign wealth funds like GIC, Temasek, and Mubadala, mutual funds like T. Rowe Price, Fidelity, or Wellington, and crossover hedge funds like Durable Capital or Green Oaks. When setting targets for a fundraise, it might be counterintuitive, but Zoe and Adam advise against going for the highest valuation possible in the short term. Instead, treat this like a strategic decision in a decade-long plan. Now, what does that mean? To set your raise amount and valuation, Zoe recommends working backwards from your next raise milestone.
The easiest way to think about it is you work backwards from what your milestones are for the next raise. So how much money do you need to get to your Series B milestones?
And when actively fundraising, Adam suggests that later stage companies may want to aim to be 2 to 3x oversubscribed on their fundraise.
We're raising well below the price that we think we could actually go and raise at if we only optimized on price. If, the market multiples trade down 10 to 15%, if our financial plan comes up a few percentage points short, do we still feel comfortable that we could raise at least flat, if not up?
This kind of thinking from Zoe and Adam has two key benefits. First is you're more likely to be able to raise more capital if for some reason you need to return to market quickly. And second, by going for a more reasonable valuation, you're creating a buffer so that it's easier for you to have an up round on your next fundraise. And being able to raise at an up round is not only good for optics and investors.
Companies are so levered to their share price in terms of employee morale, the value of the equity, which leads to retention of employees.
Your company's equity is a key incentive to attracting and retaining top talent, and we'll talk about why this is extra important later in the video. If your equity is going in the wrong direction, it becomes much harder to do any of this. Once you've secured funding, having a clear investment strategy is mission critical. When deciding how to allocate your new capital, Adam warns against a very common pitfall of evenly distributing this capital across several departments, a little bit to sales, a little bit to marketing, a little bit to R&D. Instead, Adam's more of a fan of highly concentrated and targeted investments into high leverage growth areas that will help you hit your presumably aggressive growth targets.
When you look at where the investments are going, that they're appropriately geared towards growth. So think about sales and marketing, think about R&D, and that there's not a lot of waste in G&A functions that are not kind of contributing to growth. You need to understand what are the key bets and what are the biggest levers that are required to be true in order for us to hit this financial plan.
And by the way, if you want more content from Adam on how to strategically allocate your capital, we have a complete capital allocation playbook written with Adam in our description down below that you can download for free. Now, Zoe and Adam were asked if they could only focus on two financial metrics to guarantee that they would reach $100 million in revenue, excluding the obvious ones like revenue growth rate. Adam highlighted win rate and retention. Why win rate?
It's an indicator of product market fit, and also back to sales efficiency. It's hard to have a really inefficient sales funnel if you're winning most of your deals.
And Adam highlights retention rate because of the leaky bucket problem.
It's at 10 million of ARR. If your retention rate's 80%, you churn $2 million of revenue a year. That means you have to go sell $2 million to net new customers just to kind of get back to no growth. Let's say we're getting closer to $1 billion, 20% churn is $200 million that I have to go out and find in the sales force before I can even think about growing. You will never be a $1 billion plus software business without a strong retention rate because that hole becomes too big no matter how many new customers you're acquiring.
Zoe agreed with these two financial metrics, also adding that for early stage companies, she also looks at sales velocity.
Understanding how quickly the customers that you have in the pipeline are converting and actually winning those deals.
Now, I told you we'd come back to talent because beyond financial metrics, both Zoe and Adam agreed that talent acquisition and retention is the single most important determinant of success.
You can't attract and retain high quality talent, then incumbents are going to win.
And attracting and retaining top talent becomes even more challenging as your company scales. As your company gets larger, it becomes more representative of the broader workforce, meaning it's harder to maintain above average talent. Therefore, companies that excel at talent management actually have a huge competitive advantage over others that Adam says does manifest itself in your financial metrics over time. All right, now it's time for the action audit, where I try and give you 3 actionable things that you can do tomorrow based on what you saw in the video today, all in 30 seconds or less. The first is for founders. Self-reflect and have an honest conversation with yourself over whether or not you believe you're truly adaptable. Have you been meaningfully adaptive in the last 12 months with all these changes happening every single day? Do you know when to pivot, when to stop, or when to keep going with conviction? If not, seek advice on how to become more adaptable. Identify your ideal investors by stage and then write them personalized emails, giving them some updates on your company, but not necessarily looking for funding right away. The idea is to encourage you to start building that relationship now before you even need it. Lastly, whether you've raised or not, you need a strategy for capital allocation. Tomorrow, review your current plan and see if you're making those highly concentrated and targeted investments in your highest leverage areas for growth. If you want to join 19,000 other CFOs and controllers who get this kind of content in their email inbox every single Wednesday, join the Spendsetters newsletter in the description below. Thank you so much for watching. Make sure to subscribe, like the video, whatever you want to do, and I'll see you in the next one.